Hello and welcome to your own channel. Let's talk business once again. As always, I'm excited to have you here. Well, this is the fourth video presentation in this series where we are covering the London Matters 2020 report. In this short video presentation, we will see and talk about two important aspects of this report. The capital that underpins the London market's underwriting. We will also see where the world it is coming from. And finally, why do people invest in London market? The second important aspect is London insurance market and insurance linked securities. So very interesting topic. So as always, there is lot to know and lot to discuss. So without waiting more, let's start talking business. So for those who are new to the channel, I am Ravi Shankar. I am having more than 16 years of experience as a business analyst, largely associated with P&C and general insurance domain. Currently practicing in Lloyd's of London. If you have any queries related to this video presentation or my previous video presentations, do reach me at my Hotmail or my LinkedIn profile. I'm also available on Twitter. So if you want to connect me on Twitter, you can connect me over here. Here's my Twitter handler. Once again, thanks a lot for all your emails or your suggestions. I really love them all. So for those who are watching this video presentation first time, so this is our fourth video presentation in this series. And as I said before, in this series, we are discussing about the LMG's London Matter 2020 report. So the agenda of this series is mentioned here. Right now, we are going to cover the global capital base, where we will talk about the capital that underpins the London market underwriting, looking at where in the world the capital is coming from, why do people invest in London market, and finally the form in which the capital is getting invested in the London market. We will also analyze the profile of the carriers writing business into the London market and how they have evolved over the period of time. And we will also discuss about the various group initiatives like modernization, business environment, talent and diversity and other aspects of the report in subsequent video presentations. So let's move ahead and let's start talking business. So the London Matters 2020 report confirmed that the ongoing modernization of the London market between 2010 and 2018, if you see carefully, there is an increase in amount of capital invested from all the region outside the UK, with few exceptions as UK and Bermuda. Now, if you can see over here, the UK has gone from 23 to 28%. Europe from 16 to 20%, rest of the world is 16 to 22%. Whereas if you can see over here, the UK fell from 28 to 16% and Bermuda from 21 to 18%. You might be thinking that why international players are investing in London market. On the other hand side, why do company domiciled in UK fell by 11 percent point between 2010 and 2018? Well, the reasons is very simple. The international insurers want to widen their portfolio to include more exposure to the specialty risk to service the increasingly international operation of their domestic line in varieties of industry, and London market being a center of global specialty insurance is their natural choice. And of course, this trend is also indicating the globalization in the world in general. Secondly, the globalization also influenced the London-based investor looking beyond their own boundaries for investment opportunity, and that's the reason you are seeing the decline of 11% in the UK. Okay, so now we understand why international insurers are investing in London market. So let's zoom in more and understand who these international insurers are and where they are coming from. If you observe carefully, the majority of investment is coming from Asia between 2013 and 2018. And if you specifically talk about the majority of investment is coming from Japan. If you see over here, Tokyo is from Japan, Sompo is from Japan, MS and AD is from Japan. CM stand for China, Mustang Investment Group is from China, Sompo is from Japan. So there are two main reasons due to which the Asian insurance companies are coming to London market. First, the companies from Japan and Korea has been driven by the need to expand beyond their stagnant insurance market, or I can rather say that the stagnant domestic market. Secondly, developing the capability to compete in the complex overseas property and casualty risk is also one of their key area for which they wanted to expand globally. Additionally, to gain more knowledge and experience of property and casualty risk in London, capital providers in emerging market have also been investing in London market, like China Re invested in 2012 and GIC Re from India invested in 2018. And finally, when we talk about the investment in London market from US carriers, this is mostly happened via the merger or through buying a Lloyd vehicle like syndicates. This reflects the US investors' desire to diversify and access specialty risk. Now let's go ahead and see what role of private equity firms are in London market in terms of capital investment point of view. So between 2015 and 2018, there was a significant private equity investment in London market companies with 6 deals worth more than 250 million pounds. If you see carefully, there is a change in the strategy when it comes to the private equity investment. Earlier, the private equity firms were targeting mainly brokers because they offer steady cash flow, high client retention rate, and strong revenue. But the latest data shows private equity has also been targeting the insurers during the later part of 2017 and 2018. According to the London Matters 2020 report, the key trends are an increasing focus on investing in consolidation platform, mostly within the broker space, to create economy of scale through acquisition. The use of private equity capital to invest in startups that have distinct value proposition in the area where there are gaps in the market. Third and final one, the focus on profitability through greater cost discipline and technology driven efficiency. Now moving ahead, here is a very interesting topic about the alternative capital. Now, before getting into this slide, we have to understand what is alternative capital and why it is important in the reinsurance and insurance world. In late 80s and early 90s, several large losses from US catastrophes like Hurricane Hugo and Andrew and the Northridge earthquake put a large strain on the capacity of the reinsurance market, which was estimated close to 50 billion US dollar to 100 billion US dollar. Although the situation has been eased in last few years, but the prices in the reinsurance market remain very volatile, and it could potentially increase again, perhaps significantly, after one or two major future catastrophes. Innovative mechanism has been developed in recent years to stabilize this pricing and coverage by transferring risk in security or derivative form into much larger pool of investment capital available in global capital market. Remember, I'm not talking about the reinsurance market, I'm talking about the global capital market. Since the catastrophe risk is inherently uncorrelated with the financial market, such instruments are also attractive to many type of investors. Thus, an integration of reinsurance and the capital market can be mutually beneficial for both insurer and investor, providing insurer with the reinsurance coverage at the reasonable and stable price and offering the attractive securities to investors. The term alternative capital has become popular as a way of describing the phenomena of financial investor writing reinsurance under the single umbrella. Over the past decade, the insurance industry has evolved from simply a method of financing risk to a source of opportunity for the investor. The investors are now looking for commercial property insurance market as a way to diversify and minimize exposure of risk through alternative capital. Now, some of the investors are pension funds, hedge funds, mutual funds, and sovereign wealth fund. What are the various instruments when we're talking about the alternative capital? The instruments are catastrophe bond, collateralized reinsurance, reinsurance sidecar, or insurance linked warranties, which we also called ILWs. Right? So we will talk about it quickly for you to understand. Now, when we talk about the insurance linked security, they are the financial securitization of the insurance risk. They allow capital market investor to participate directly into the reinsurance market and are an attractive option for the investors to seek diversification of their holding and potentially higher rate of return than the available elsewhere. Now, one of the most common uses of this approach is catastrophic bond, or which we also call as a cat bond. The cat bond were developed in the wake of global shortage of reinsurance following the 1992 hurricane season in US and 1994 Northridge earthquake. Now, what are these catastrophe bonds? So the catastrophe bond is a derivative debt investment vehicle, which is also called as the special purpose vehicle or special purpose insurer SPV or SPI, issued by the insurer and reinsurer, designed to raise investors' capital to cover the catastrophic loss. Now here we are talking about the investor capital to cover the catastrophic loss, not the reinsurers. Cat bonds are generally issued to cover either a specifically identified event like Japanese earthquake or the possibility of a certain magnitude of loss. Cat bond investors' capital is deposited into a collateral account where it is invested for the duration of the bond. Then if the qualifying event occurs which meets the trigger condition to activate the payout, the SPV will liquidate the collateral required to make the payment and reimburse the counterparty according to the terms of the catastrophe bond transaction. If no trigger event occurred, then the collateral is liquidated at the end of the cat bond term and investor being paid with the principal and the interest on top of it. So if you can see over here, here is the cedent, here is the special purpose vehicle SPV or SPI, and here is the investor. So cedent will set up the SPV and they will put the premium over here. They will get the reinsurance coverage over here. Now the investor, they will put their principal over here to cover the reinsurance, and then if there is nothing happen, if there is no loss happen, no catastrophe happen, then they will get back their principal with the interest. Now this SPB will set up the trust, and in this trust will have the principal secured in this trust, and then in event of any loss, this trust will pay back the cedent in terms of reinsurance. Now this is how this catastrophic bond work or cat bond work. Now coming back to the collateralized reinsurance. Collateralized reinsurance is the reinsurance contract or the program which is fully collateralized, typically by the investor or the third party capital. Normally the collateral is equal to the full reinsurance contract limit less any premium. Like any other ILS alternative capital instrument, the collateralized reinsurance market enable institutional investor to directly participate in the reinsurance market and provide the source of risk capital to the cedent in the market. Moving ahead, let's quickly discuss about what is this reinsurance sidecar. Very interesting and important topic for those who are studying reinsurance. The reinsurance sidecars are limited purpose reinsurance company that provide insurers and reinsurer with the alternative capital to reduce earning and capital volatility developed in response to hurricanes and other catastrophes. Like traditional reinsurer, the sidecar reinsurance assume a portion of ceding company's underwriting risk, including loss and expense, in exchange of like percentage premium. Hence the term sidecar evolved over the period of time. The sidecar reinsurance agreement is typically a quota share agreement. Now this is the proportional form of reinsurance where we are largely talking about the quota share. So you might be thinking how this sidecar is different from the traditional reinsurance. Now the point number one, they are privately financed. Okay. Second, they exist for the defined risk period and finite lifetime, usually 24 months or less. Their risks are defined and limited. They are typically limited to the single cedent. And last but not the least, they do not have an active management group or a staff to manage. All right. So these are the typical differences between the traditional reinsurance business and the reinsurance sidecar. Now coming back to industry link warranties. Now industry loss warranties are reinsurer or derivative insurance contract with loss trigger that are based primarily on the industry threshold and not the insured's own losses attached to the specific event. It actually triggered based on the industry as a whole, right? So whether it's a sidecar, is a cat bond, is a collateralized reinsurance or the industry loss warranties, fund needed to be available in form of collateral to ensure the claim can be paid when their losses arises, right? So now coming back to this slide again, as the number of London market business has diminishes through acquisition, there are fewer opportunity to invest directly into the London market. And this is stimulating the appetite and the opportunity for the institutional capital provided to invest directly into the London market through alternative capital vehicle such as insurance linked security. Now, if you can see over here, when we're talking about the capital deployment, now you can see it has been grown from 22 to 97 billion US dollar when it comes to alternative capital in the London market. On the other hand side, there is a growth in the reinsurance, but if you can see, the growth is very marginal as compared to the alternative capital. And that's the reason why the alternative capitals are more preferred in the London market, as it is there in the Bermuda market. Now, the researchers shows that the alternative capital investment tripled globally between 2009 and 2018, which much of is being driven by the ILS market in Bermuda, which specializes in US natural catastrophe reinsurance. Now, if you are following the Bermuda market, you might have observed that the Bermuda market in leaders in providing the insurance linked securities, and that is their specialty. Now, how the London market is responding to this competition of Bermuda ILS? Now, in 2018, after lobbying by the London Market Group or LMG, the UK government responded to the Bermuda's continuous growth in the area of ILS by putting in place a legislation to develop the ILS market in London. The UK legislative and the regulatory ILS framework and the tax arrangement are globally competitive and have been broadly welcomed by the investor, and they have a huge potential to grow. And let me tell you why. The UK government is actively engaged in the ILS market and working to improve it. That is point number one. Point number two is about London's extensive geographic connections to the world major insurance market, which means that it can access the new risk in many more geographies, not just in North America. The third important point is about the London spread of business across the class of business, including life and non-life, that gives it a broad scope of new business opportunity. Finally, the many leading ILS market are based in offshore location. This can create additional cost and complexity due to some countries' restriction on the transaction and offshore territories. London ILS business does not incur such type of cost. Well, that's all from today's video presentation, and I hope you have gained some knowledge from today's session. Thanks for your valuable time. Goodbye and take very good care of yourself. Bye, and I will see you soon in the next video presentation in the same series. Bye bye and take care.